Good afternoon, everybody. As the announcer said, my name is Jared Carney, founder and CEO of Lightdale LLC, based here in Los Angeles, California. And welcome to the 2025 Milken Institute Global Conference. It's been many years of delivering a truly international and global experience for investors, allocators, corporate executives, philanthropists, over now just so many different types of opportunities. And as investors, we really care about performance, and we care about seeking and pursuing and securing alpha. And I'm honored today that we have such an illustrious panel that represents, between everybody here, almost $3 trillion in assets under management and capabilities, and probably between they and their teams, some hundreds of years of investment experience and acumen. So I'm here to learn, and I hope you're here to learn with me. I'll quickly take you through who everybody is, but I'll lay off the long-form introductions. I ask you to look at your apps, or if you're online and watching the stream, you can do your research on who everybody is. They'll give you a little bit about themselves and their firms, but we're really going to dive into a conversation about, particularly in uncertain and volatile times, how to achieve and sustainably secure alpha. To my immediate left, we've got Khaled Almari, CEO of Real Assets for Mubadala Investment Company, based, of course, out of the United Arab Emirates. To his left, we have Ashley Baum, Managing Director, Head of Special Opportunities for Texas Retirement System of Texas, Teachers Retirement System of Texas, the Trust. To her left, Jeb Bentley, who is the Executive Vice President and the CIO of Northwestern Mutual. To his left, Sarah Malik, who is Head of Equities, Fixed Income, Chief Investment Officer for Nuveen. And finally, but certainly not last in any sense, is David Mahalik, Co-Head of Global Investments for Barings. So as you heard, we have really quite a lineup here. And so without further ado, I just want to give everybody an opportunity to tell just a quick soundbite about themselves and tell us something about you that makes you what you think is a better investor in these uncertain times that doesn't necessarily have anything to do with your business. And David, we'll start all the way at the end with you.
Sure, thank you. So I started my career in the Air Force as an officer, active duty, and one of the sayings I'll throw out at work sometimes, which people look cross-eyed at me, is flexibility is the key to air power, which is a saying in the Air Force, which basically means you can have a plan and then the war happens and you have to adjust as you go. I think Mike Tyson adopted it to say everyone has a plan until they get get punched in the mouth. And so I think April was probably a bit of a punch in the mouth, or a time where we need to exhibit flexibility. But I think that beginning of my career sort of taught me the training was, be calm when things get uncertain. Think about the long term. The only option is to move forward and to adjust to the circumstances that are in front of you. You can't go back. You can't change the past. You got to work with what you've got. So I think that perspective is something I think about, especially in periods like April.
Thank you, David, and thank you for your service. Sarah?
Sure. I tend to not do what I'm told, and I'll start it with a story of I grew up in Stockton, California, and when I went to high school and I was graduating, I went to my guidance counselor and I asked him what I should be thinking about when it comes to college, where should I go? And he told me he didn't think I'd make it through college, so it wasn't really worth applying to college for me. So the good news is I didn't listen to him, and I did go on to get my master's degree. But I think that helps me investing in the markets, often just going against the grain, going against consensus, especially during times of volatility, leaning into it, looking for those asset classes where there's dislocations and valuations, and having the guts to step in when everybody's running for the exits. That's what I've learned over my 30 years investing.
Thank you. Jeb?
So my colleagues have heard this before, but I played 3 sports in college, and while that might sound cool, I went to a Division III school, and I was mostly on the bench. So obviously not a gifted, talented athlete, as you can see. But I think what pertains to investing is really that sort of day-to-day grind of getting up, preparing, a lot of times getting knocked over, getting backed up, and just kind of rinse, repeat, and taking learnings away from all that. So I think that helps me, I think, as an investor in terms of that resilience.
Great. Thanks. Ashley?
I had the fortune to start my investing career in 2007. right at the peak of the market. That was the day I reinvested my 401k from my prior employer. I can literally time it. And, we obviously proceeded to have an incredible 2008, 2009. And the thing that really stuck with me and I think prepares me and makes me a different kind of investor today is at one point when I joined the trust, it was at $117 billion. We got down to $67 billion. And that was, if you think about it, we lost $50 billion in 15 months. And our CIO was sending out a note every day, be like, hey, we lost $3 billion today. Here's where we are in a cycle. And every single day he'd say, hey, if this is a normal market cycle, we're going to lose another $10 billion before this is done. Go find me some things to buy. And I think just that historical perspective and being really young and saying, hey, this is a cycle, right? Like everyone else is freaking out, but we've got work to do. And that just taught me, in times of dislocation and times of volatility, we are the safe hands in the market. I think everyone up here is. So this is actually the time when we get the most excited. And it's when we can really rotate portfolios, find really unique opportunities. And that's what I've built my career doing.
Thank you. Khalid?
Good afternoon, everyone. It's a great pleasure to be here. I love nature. I love hiking, and that's kind of really my passion. I try to do 1 or 2 active holidays almost every single year. That's where you get perspective, you broaden your horizon. And one of the most transformative experiences or adventures I had was many years ago when I climbed Kilimanjaro, which is the highest peak in Africa. And if you're familiar with Kilimanjaro, it takes about 4 days to basically ascend. And the first 3 or 4 days, the easiest ones, but the last one is the summit push, where actually you need to start the push and the climb around midnight, 11 p.m. No food, no sleep, Arctic almost climate, freezing, windy, and very, very steep. And how many times you have this conversation between you and yourself about giving up on something, like once every 5 years, once every 10 years, once every 20 years? During that summit push, the 8 to 9 hour summit push, you almost have that conversation once every 10 to 15 minutes. What am I doing here? Why did I come here? What am I trying to prove? And you just keep going and keep going and keep going. And having that kind of, hundreds of conversations about giving up and not giving up in a very short period of time is life-changing.
I mean, these are terrific answers, and we can go in such personal directions, but let's keep it focused on investment. And I think we can see how these would influence you as leaders of people in making investment decisions. But on a personal level, right now, given that you've all talked about pattern recognition and cyclicality here, where are you? What's resonating? Where are you going back to? What's Sarah? What's the echo that you're seeing?
Well, the world is becoming more complex, and correlations between asset classes are picking up. I think there's 2 reasons behind this. One is central bank moves are definitely moving the globe much more efficiently, and also geopolitics are having so much more influence. So if you go back to when I started in the industry 30 years ago, there was the typical portfolio 60-40 equities and fixed income. It was actually created in 1966 by William Sharpe to have the best risk-adjusted return. But markets are not static, and I think over time that portfolios are not something that we can set and forget. And asset allocation for investors is probably one of the most important financial decisions they can make to help them reach their goals. So I think that the winners going forward are going to be those who evolve their portfolios into something more of a 50-30-20, 50% equities, 30% fixed income, 20% alternatives. All of these new asset classes provide less correlation between other asset classes, more inflation protection, more diversification in these asset classes like infrastructure, private credit, even farmland, where Nuveen's one of the biggest owners of farmland in the world, can provide that excess diversification, because we have seen equities and fixed income become highly correlated over the past few years.
Jeb?
Yeah, so I agree with all of that, Sarah. I think that's well said. For us, maybe I'll start with our mission. And so for us, we're a 167-year-old insurance company. We're focused on giving our clients financial security, and that's through planning and insurance and investments. So the way we think about navigating these markets is we think about, on the one hand, really taking risk. We take more risk than most of our peers. We own, for an insurance company, a lot of equities, whether public, private, real estate. So we want to do that, and at the same time, our financial strength is really important to us. So we want to make sure when we go through these periods of disruption, that we're the strongest company out there. And so that's how we think about it. I think the way Sarah put it is well said. For us, we think about really those higher risk assets, maintaining a long-term time horizon. We like illiquid markets, but fundamentally, like public equity is equity, private equity is equity. Both have earnings, both have valuation multiples. So we want to keep that in mind and not get too hung up on the labels, but really think about how do we optimize this portfolio over a 10, 20, 30-year time horizon.
You all do seem to have duration or lack of duration concern in common on this panel. I wonder if that is something that you think is specific to or necessary to have a true multi-asset business. Do you have an opinion on that? Jeb, do you think that you have to
I
have
do.
that?
I mean, I think for the way we invest, so we've been investing in private markets for 4+, 5+ decades, and we like that. We think having those long tenor liabilities is really important. Our product mix is a very long-term product mix. We have about $2 billion in liquidity a month that gets generated that we have to invest. So when you kind of have those features, that allows you to be a little bit more long-term. And I think the other institutions on the panel have that same kind of permanence and long-term horizon.
Khalid, you represent a substantial amount of the business of arguably the world's most nimble and rapidly growing sovereign wealth fund. How do you think about the echoes that you hear in the market today and the way that your business is constructed as a way to meet the opportunities?
Well, let's just put a disclaimer, we're 20 years old, so we're the youngest, so we're still learning, and the learning curve is quite steep, and we're evolving. So in Mubadala, we always take a long-term perspective, a perspective that we're in the long game. Volatility is short-term. We live in an unpredictable world. There will always be volatility. So when we build our strategies, we build strategies that are resourced and devised and structured in a way that can withstand these volatilities. Assets will always be there. We invest in assets that can last there for decades. Volatility is short-term. Presidents come and go. Administrations come and go. Macro shifts happen, but they will always, evolve and change, and things will always change. So our strategy is always long-term. However, having said that, it's important to be agile and adaptive. There will always be these kind of changes from time to time. So your strategy needs to have the flexibility, the agility, the liquidity to pivot tactically. You need to be able to adjust your capital deployment. You need to be able to adjust your geographical diversification. So agility is very important in our strategy. And if you look at Mubadala, we started with 50 million USD, and we've grown into 330 billion AUM across many sectors and asset classes. If you look at our 1-year IRR in 2024, is about 10.3. And if you look at the 5-year IRR, is almost identical. What that shows the resilience of the portfolio. And that's exactly our kind of DNA and how we think about investing.
Excellent. And Ashley, the role of your business in the greater trust portfolio?
Yeah, I'm actually going to, if it's all right, I'll
Yeah,
pick up on some of your comments around resilience. The way Texas Teachers does our asset allocation is a bit unique. It was put in place in 2006, so it's been a very long-term commitment that we've made. But what we think about in the world is we also don't know what is going to come any given day. And so we actually build our portfolios around economic regimes. So we don't have a diversification framework that says we need diversification in just various asset classes against the volatility and correlation. Instead, we say we think there's really 3 major economic regimes in the world. There's global equity, which times are good, and like you, we consider private equity another form of equity. So it's all just equity to us, whether it's internal, fundamental, quantitative, private, it's all just equity. That's where we have the bulk of the portfolio, so 60% of the assets sit there. That roughly correlates to the amount of time that we've been in that economic regime since post-World War II in the developed world. Then we have 2 other portfolios, a 20% portfolio for inflationary times, a 20% portfolio for deflationary times. And one of the things that's most unique about Texas Teachers is you would think, oh, it's a pension fund. They must have tons of credit. And the answer is we actually have none. not strategically. And that's been true since 2007. And so what we do is we look at credit entirely as a tactical asset class. Most of that actually does come through my portfolio. So I run a program called Special Opportunities, and we are almost the ghost of the trust. We are sat in a place to say, what are we missing? What are we not doing enough of? What is new and different and unique? And so we look at times like these and say, what does the trust need to be doing? And our big focus, and I'm happy to talk about it later, our big focus is on providing liquidity. So when we see problems, that's where we try to shift the assets of the trust to fix those problems for others.
Thank you.
You know, I think it's interesting that we discussed this on the prep call too about how you don't own any fixed income, and I was talking and saying that we would take the other side of that bet in the sense that, well, first of all, investors do need liquidity, which they can get from the public part of the market, equity or fixed income. But fixed income in general can provide you equity-like returns for much less risk. So as an example, high-yield corporates right now bringing in about 8% returns. You can get that with much less risk than you can in the equity market. And then interesting, if you look at correlations over history, so in periods of inflation, real assets, so this is like infrastructure, real estate, tend to outperform other asset classes. But during periods of economic downturns, that's where fixed income and equities can become much less correlated. So fixed income can be a nice cushion to equities during economic downturns. And that's the reason why we actually think public fixed income is an important part of clients' portfolios.
David?
And just as a correction, we have fixed income. We just have it all in treasuries and tips. So there's just not a credit component, just for the record. So.
David, you're running asset management, insurance.
Yeah.
So you're fixed. You have a lot to say about fixed income and equity mix.
And credit as well. We have a big credit book, and I think that's an important when you thought about the title of the panel is very broad, right? Multi-asset. In my view, you've got to have a reference point when you think about generating alpha, right? And you can paint sort of broadly as low, medium, high risk. Think of that as IG, high yield, equity, and so you have to start somewhere. Otherwise, if you just look at every asset in the world you can invest in and say you generate alpha against what, and so generally when we're talking to our clients, it's sort of in those broad risk buckets, and then it's within that, what are your goals? And what is your time frame? So what's your risk tolerance? What's your time frame over which you want to achieve a certain return? And how do you think about liquidity, especially with all the talk now around privates, and privates are going to take over the world. There's some point at which liquidity matters as well. And so when I think about, our broadest multi-asset capability is our high yield capability. And if I think about over the last 15 years as we've built that franchise, when I joined the firm, I joined a U.S. bank loan team. And in 2010, we launched a global loan strategy, which was U.S. and European loans. And shortly thereafter, you had the Eurozone crisis. And so it created this huge opportunity in European loans that didn't exist in U.S. loans. So we were way overweight. So that was sort of an early, why does multi-asset make sense? Like there are the fundamentals, which can kind of move in a certain way. And then there are technical things that happen in a market that create compelling opportunities. A few years later, we added loans and bonds into the mix. And then you had the taper tantrum, and you had energy crisis in 2015, which mostly impacted the U.S. high-yield bond market. And so the ability to pivot within those four asset classes created huge opportunity. And then over time, we built out that capability, added structured credit, added ABS, added emerging markets. And again, always in that strategy, there's a reference point, which is the U.S. high-yield bond market is the biggest, most liquid below investment-grade credit market. And so hopefully, not in every situation, but over a cycle, over a period of time, adding all of those other things into the portfolio should create excess return, relative to your risk budget against some sort of reference point. And so that was sort of the beginning for us of multi-asset. Now we're thinking about IG the same way. Now we're layering in private credit alongside liquid credit. But that's to me, like when you think about why you do this, that's something that we've built over 15 plus years organically, and frankly been doing it for our parent company MassMutual over I haven't been there. No one's been there 100 years, but you're 160. I think we're 170 years. I always think it's fun when you go back and say for 170 years. Well, no one that's in the chair today has been for 170.
Sometimes it feels like it. But I love your comments, David. I'd maybe add two things. One is we really like private markets. We've been investing there for a long time. But there are limits to liquidity in both public and private markets. So we've got great teams in both. I think about COVID going through that period. we were trying to buy about 100 million of high yield a day, and there were limits. You know, we could maybe scratch our way to 100. We couldn't get to 200 or more. So like in both markets, there are certainly limits to liquidity. The other thing which I think is interesting, you alluded to, like private credit is you know, very predominant in the headlines. And you know, we worry that some institutions and retail investors aren't thinking hard enough about their liquidity. So you know, you allocate to illiquid assets, you expect to get an incremental return, but there's no guarantees. And so I was joking with Jared, like illiquidity, the illiquidity premium is not a law of physics. You know, it's something you hope to get, and most of the time you do get it. And these are great markets, but you know, don't just assume it's going to show up, you know, in your mailbox tomorrow just because you think you're going to get
Well,
it.
there's also assumption that it's comparable risk, right? Which over time in an efficient market it should be, but if a lot of money is chasing the same, you know, return, there may be periods of time where you're getting a premium, but maybe you're taking more risk and you don't really know it until you go through a cycle.
Well, let's put this in the context of, say, called the last 60 days, because this is, to me, probably the best petri dish to see what's actually happened. With the volatility and uncertainty heavily influencing global markets today, you know, what, as international investors, can you focus on, given the macro environment, that will generate the kind of alpha that we're talking about with the kind of risk parameters, Dave, that you and Jeb were sort of batting back and forth? Khalid, you want to take that first?
Yeah, I think, listen, I alluded to the fact that, you know, you need to be long-term oriented, you need to have a long-term perspective. But at the same time, it's important to always base your strategy on an information advantage-based conviction. You need to start with this. You need to have the conviction. Because when you have conviction will help you turn confusion into confidence during foggy times, during uncertain times. And you need that navigator and you need that compass to help you go through that kind of foggy, uncertain times. So, and once you have that conviction, it's important to have the discipline to stick to that strategy. Because if you look at 99% of the investment mistakes that people make, you will always find a way to attribute that to lack of discipline, or getting too creative, or getting too opportunistic. So it's important to stick to that discipline, but at the same time, that's not religion. You know, your strategy is not religion. You have to always refresh it. You have to always diagnose your strategy. You have to always, from time to time, run a diagnosis, see what went well, what didn't go well, and build on it and refresh it. And it's important to act fast on that refresh exercise. And then, and this is some of the stuff that we learned actually the hard way and that we continue to learn, is it's important to think about the alpha stack, which I think you, David, alluded to that, you know, when you mentioned, you know, layering your investment. So you got to really layer it like a cake. So you need to make sure that you optimize on the capital stack to ensure that you achieve the best possible return with the best risk-adjusted methodology. So imagine, for example, if you're investing in a bond or a fixed income, and then you kind of, you know, gain a few percentage points by having short-term trades, and then you add to that some call options. So the alpha stack is very important.
Sarah?
I'll go with my favorite asset class right now and our biggest surprise of the year. So favorite asset class, real estate. Private real estate off about 15 to 20% from its 2022 highs. We think when you look at real estate, when it bottoms, it usually has about a low double-digit return upcycle from there. The headwind for commercial real estate has been commercial real estate, which we think is bottoming and slowly improving. And then other areas of real estate I still think remain attractive, from retail to industrial to senior housing to student housing. So I think that's a sector that we're seeing flows going into, and I think it has it looks quite attractive from here. Biggest surprise of the year, I'll say, on the equity side, not the tariffs and what happened with the markets, but the fact that non-U.S. markets are outperforming U.S. markets. I don't think many investors came into the year thinking that with all these tariffs coming into place, you should bet against the U.S. as an equity investor, and that's exactly what you should have done to generate the most returns, leading with China of all places. And I think that started with the DeepSeek news, which to me seems like it was in a different year at this point, but when that news came out and U.S. tech continued to roll over, because it already had been before then, U.S. S&P 500 is about 30% technology. Rest of the world has a much lower weight to tech. So I think that helped other benchmarks that in some ways have been left for dead sometimes, like European benchmarks in some areas of Asia outperforming the U.S. And my view is that it probably continues for a time this year, but I'm certainly not counting the U.S. out. I think once we're past this bump in inflation due to tariffs, U.S. will settle down. And I think the U.S. could take the lead again, especially after seeing technology earnings for the first quarter, which looked quite strong in select pockets.
I feel like saying what volatility, right? we're back to values on the equity market in advance of Liberation Day. So you asked the question, what do we do in a 60-day time frame? The answer is, well, at least for me, I get on the phone and I call a lot of my managers. So I run the opportunistic pool. We have thousands and thousands of boots on the ground, that work through our external network. So I pick up the phone. I start calling. What are you thinking? How are you guys looking at this? And I would say what's unique, sitting in my seat, I've now done this through several crises. A lot of times managers are more afraid than you'd think. It is actually, I can remember distinctly in 2008, 2009, arguing with managers about how much money we wanted to put out. And they'd say, well, but the market could go down more. Like, well, yes, and then I have more money to give you. So just please go put this out. Right. And I distinctly, in COVID, there were so few of my managers that were willing to actually deploy capital. So I had one manager, and I just said, give me all of the high yield bonds that you own inside your hedge fund. Just buy all of it. Just buy anything you can find. And he was very nervous, and he said, well, but if it goes down, I said, then there's 300 million more behind it. So I think sometimes as those strong hands, you have to push a little bit more. What was unique, I think, here about the tariffs in the last few weeks, there really wasn't any dislocation that is happening in the market. Things were very orderly. We were expecting to see gapping. I think there were just 2 days that the high yield ETF was off of NAV. There was nothing really happening. There was no crisis. Everyone was very polished and professional about how the markets were working. So in short, we actually didn't do a lot. The only thing we really did was we had a need internally for other reasons to invest more in the U.S. equity market. And given the volatility, we held off on that. So that was the only thing we did really tactically through the last 60 days of the trust.
David?
Well, I was just thinking of what Ashley said, like the importance of the relationship between an asset owner and an asset manager that's built over decades, hopefully, so that when you have periods of volatility, you can act with conviction. Right. So I'd love you to. I'm surprised the manager would be afraid to deploy in that environment. I mean, that's sort of the dream situation, right? As an asset owner, to have a client when the world looks really ugly come to you and say, put more money to work. And I think, but again, and then particularly if you think about that when there's a broad-based event like COVID that's impacting everything, right? To do that in a multi-asset context. So you've underwritten the relationship in an enterprise and multiple capabilities, and you say, here's money, go find me the best value. And that, again, we're owned by a large life insurance company, so our DNA has been doing that the entire history of our firm. And that's certainly when we think about multi-asset and how we engage with clients and broaden the things that we do, that is the dialogue we're trying to have. And I would echo Sarah's comments on real estate. I think real estate credit scenario, we've got a lot of momentum now, and it's people that are kind of full on the corporate private credit, and that's sort of the headline. But then between real estate, infrastructure, there's sort of ways with asset backing to get similar returns. You've got to be able to originate and put the money to work. But I think the dynamics in that market are very favorable, and real estate equity as well. I think that's an area too where you paint with a broad brush, but the difference between the central business district in Sydney versus New York versus Cincinnati versus London, like that's all real estate, and the individual investment decisions are local, but that is a multi-asset opportunity set that you need a global footprint to really be able to take advantage of.
Jeb, when you hear this conversation around a specific asset class like real estate or infrastructure, for example, how deeply do you get involved in structure? Right. So how much will you, as an asset owner and the person who owns the asset allocation mix, and the person who's charged with alpha and the seeking of alpha actually get into structuring?
So I'd say to a significant extent, I'd echo kind of what David said. So we are a little bit unique in that our general account, our institutional portfolio that backs our insurance business is about $300 billion. And I'd say about 95% of that we manage internally. We have some really important strategic relationships with private equity firms, other alternative investment firms that we definitely lean on in the same way that Ashley was talking about. But I would say the fact that we manage those internally gives us a lot of flexibility and ability to move quickly when we go through these periods. We don't have as much friction between us and the manager because those are sort of collapsed into one group. So we benefit from a common vocabulary, common debates. It doesn't make it easy. A lot of times when you go through these periods, the real estate team wants more capital and the high yield team wants more capital and the corporate investment grade team. So it's still a lot of debate back and forth, but we get pretty involved, and I think it's a huge benefit to have those internal teams focused on kind of generating the alpha. The other thing that's nice is, let's say we tell our real estate team, hey, we're going through a tighter liquidity period. We right now are seeing fantastic pipeline on the private credit side, so we're going to do a little more over there. When those private credit deals do really well, the whole team benefits. So the company benefits and we benefit as a team. And I think that kind of collaborative nature is really important to succeeding.
Khalid, what about you? I mean, you've got real estate and infrastructure, so arguably you're looking for yield and growth. How what's your attitude and approach to structure?
I think, listen, structure is, we live and die by structure. This is what we think about all the time. And this is your insurance policy when things go wrong. And we tend to spend more time in our investment committees talking about structure and how not to lose capital vis-a-vis making alpha. Because in the infrastructure and real assets world, if you really invest in real infrastructure with high visibility to cash flows, inflation-linked, off-take, long-life fixed assets, you should be able to deliver that return as long as you protect your downside. So structure is very important. And the way we use structure, we look at structure through two lenses. First is thinking about it from a capital stack perspective. And two, thinking about it from a governance/legal terms perspective. So let me give you an example. So sometimes, actually, we've done a couple of years ago a deal in data centers where we like the management, we like their track record, we like the quality of the contracts that they have, but they don't have a fully funded base case. So how do you protect against not having a fully funded base case? So we were not comfortable going common equity. So what we decided is to go at the mezz with some redemption to basically solve for that risk that we're not comfortable with. So if you come across an investment opportunity where you like it, but you don't like certain aspects about it, that's where structure kicks in. That's where you use structure to basically reflect the risk profile of the opportunity vis-a-vis the risk appetite that you're willing to take as an investor. Another example, for example, in real estate, sometimes we get into these real estate investments that we're not comfortable with the CapEx development aspects of that specific project. So we like to have some protections like priority, water cash flow, some exit rights, etc. So structure is really, really important.
Sarah, you've got such a diversity of asset classes. What aren't you in terms of Nuveen?
Well, Nuveen has 1.3 trillion in assets under management across publics and privates, ranging from global fixed income and equities to private placements, Nuveen Green Capital, private credit, private equity, farmland. We're the largest owner of farmland in the world. Vineyards, which is very important to me personally. Public-private infrastructure. So I feel like we are, well represented throughout the world. But it's interesting. We were talking earlier about diversification. We all, the mantra diversification. proper asset allocation, but really when you look at the last 15 years, there's been one asset class which is within an asset class that's been at the top of the leaderboard basically every year, and that's U.S. large cap growth stocks. So in theory, we're all told that we need to make sure that we allocate our assets in a diversified manner, but then you look at, realistically, and if you probably just own that one asset class, over time you would have beat everything else. But of course, that doesn't mean that going forward we shouldn't be thinking in the proper way. But so I think we're well represented around the world. I did want to mention though on Ashley's point of April, where we saw this tremendous volatility, but if you took the month of April off and you came back at the end of the month, you would have probably thought nothing happened because markets were down about 0.5%. But I thought there was one period in April, right around Liberation Day, where things did start to look like they might start to get into the gap down scary category. And that is if you're watching the dollar and 10-year treasuries. We had the equity markets plummeting, 10-year treasuries spiking, and the dollar weakening. And that, I think, was a sign that was the U.S. safe haven status at risk, where other countries actually turning away from us. That started to turn back when we heard this message that this is not a U.S. alone strategy. But I think there was that period there where it started to look a little bit scary. But for a firm of our size, we need to be prepared for the battle before it starts. We're not making huge changes during these periods unless we see some real dislocations, because it's too hard and you're going to get it wrong if you keep trying to pivot your portfolio to try to make up for yesterday's volatility. And I think investors have a bad habit of doing that, sort of selling at the worst time. The market timing is usually terrible. They're usually buying high and selling low. So you need to be careful of that and making sure that you're leaning into areas where everybody is leaning out.
And to Khalid's point about structure, though, is it possible when you're responsible for such a large asset management enterprise, is it possible to have a universal approach to structure, or do you sort of keep it at a business line by business line, asset class by asset class basis?
I think asset managers have their different ways. For us, I think it's riskier to have a universal approach, because what I don't want within the firm is too much correlation between asset classes. So we tend to build all of it from the bottom up. We have a global investment committee, of which I'm the chair of. Good news. My joke would be that nobody listens to me, and for a good reason. We have our view that we share, but it's always built from the bottom up. We're listening to what all our investors are saying, and then we're relaying that in a bigger picture view for clients. But I want, even within equities, an uncorrelated business. We're not a growth equities business. We're not a value. We're not just international within fixed income. Same thing. We're across the credit spectrum, and then these other asset classes, of course, operate, somewhat independently. So I like the benefit of sharing the information and learning from other businesses, but I don't want to deal with the cost of having one big macro view that you get it wrong, and then your entire asset base is plummeting along with it.
Dave?
Yeah, I think that's, you can't micromanage that type of thing, right? And so, but what you hopefully have at most large institutions is an investment culture that's been built over decades. And so, and again, for us, it's no matter what is in vogue or how exciting something may seem, you can never lose track of, first and foremost, the fundamental part of investing, right? There are technical things and exciting things, and if it's private credit today or it's real estate tomorrow, you can never, and a lot of money is coming in, and from an asset management standpoint, the way the business model works, the best thing to do is get that money out, because you don't typically, depending on the asset class, get paid for the commitment. You get paid for putting it to work. And, that's where, again, the investment culture, alignment, having, focusing on structure, doing good deals, again, pretty fundamental things. But I do think in any frothy market, you can lose sight of that because you start to think like, wow, we're in it. This time is different. We're in a different, like what could go wrong? It's going to just keep going like this. And then invariably, you never can predict what changes things. In April, it was tariffs, and whether that changed anything fundamentally or it's just the negotiating tactic or whatever. But I think those, again, are reminders of when you're in those situations, you're immediately now thinking about downside. And as we all know, sometimes the best way to make money is not lose it.
Right.
And David, there's something that you just said, I think that's really critical to how we think about operating in times of volatility. And so you just mentioned frothy markets. So with our opportunistic pool of capital, we actually have a 0% target weight allocation. So I mentioned, I think I said this earlier, sometimes I say we're the ghost, like we don't exist on the org chart, so to speak. There's no strategic allocation to opportunistic, and it's for that exact reason. Because in frothy markets, we've seen and we've observed, people that have an opportunistic sleeve, let's say, right? The nature of your asset allocation is, let's say you say, hey, I want 10% in opportunistic. Well, when markets are up, that's probably not when you want to be putting more money into opportunistic, riskier strategies. And so we find the ability to pick our times and not have to follow frothy markets to be one of the biggest ways that we can add alpha.
So,
Just
do
so if
you
you
add
don't
all
mind.
the alpha
First, quick
at the trust?
I'm sorry?
Ashley, do you add all the alpha at the trust?
Personally?
No, I mean this sleeve of yours. Yeah.
We are actually we are the second largest use of tracking error. My team is. So right now we currently are about 3.6% of the trust. It's about an $8 billion portfolio. It is funny for me to sit up here and at 210 billion be the boutique that's represented, but that's what I'm doing right now. So we, that portfolio is a very large decision that we make because every time we fund something out of this portfolio, most importantly, you have to sell something. And one of my favorite things to ask managers when they come in is they always want to pitch product and they want you to buy this and they want you to buy that. And I look at them and I say, what do I sell?
Why are you
And-
looking at me when you say buy this?
I mean, you were in a similar spot, right? That's all. I think you and I are in the same business. So it's always interesting to me. Well, what would you short to fund this, right? And I think that's where these folks over here, they're spending a lot of time doing that internally. But so many of the people that come in, they're not thinking about that, and that's why we have to be very careful. I think about when do we put money out and how do we put it out.
I think as markets move, there's a huge difference between sort of when you think about multi-asset, an academic exercise around if I gave you $100 million and you're buying $1 million pieces, you could probably build a beautiful portfolio and move it around and like be a really smart portfolio manager. You haven't moved the needle for any of your clients probably, right? When you can over time through cycles move fives and tens of billions around to take advantage of opportunity, that's I think what most of us are focused on again. And you get sort of again these academic exercises of what's cheap. And again, April would be a good example. What's cheap? Spreads are wide. Okay, give me 50 million to go put it to work and I can do it. Give me $1 billion, I can't do it. And so that's the reality of moving real money.
So
I was just going to say, like, I love David's point because at the core of the question, and Sarah, you and Ashley both alluded to this too, like, how do you organize the team to take advantage of these markets? And I think one of the things that we do that's worked for us is having sort of teams. So we have a private team faced off against kind of a group of important private relationships. Same thing in real estate, same thing in public markets. And we give those teams a fair amount of flexibility to go up and down the capital structure. So that allows you, when times get bumpy, you can pick relative value within those different markets in a really efficient way because I'm not going to be best suited to make that call. That's going to be somebody who's in these markets every day, kind of like you're getting at, David. So I think that's worked really well for us.
So I want to give the audience a chance to participate. We'll bring up the QR code one time, please, on the screen. And if you want to ask questions of the panel, I'll get it on an iPad. I'll get them on an iPad, and I'll do my best to put them to the panel. I want to go back to the human capital question, a point that you just made, Jeb. So you're giving these teams who are, sort of asset class and theme focused, facing a pretty substantial amount of discretion. But how do you know that you're actually giving the right level of training and familiarity about the cyclical nature, where we started this conversation, to people who, oftentimes haven't been around long enough to remember one cycle? I mean, Ashley's fortunate; she started during one type of situation here. And I'd like everybody to answer this question because, as we all know in this industry, the assets walk out the door every day. Mm-hmm. So, Khalid, you want to start us on your approach to people?
Just
making sure.
ChatGPT. They can go back all the way to. No, I think this is an important question. It's all about human capital. It all boils down to people. It's and we spend a lot of time thinking about our people. I took on this role as CEO of the real assets about 1.5 years ago. So I come from a different, asset class. So it's learning curve is steep for me. And the first thing I did, and I have two of my leadership teams here, the guy who runs the real estate behind Bruce and the guy who runs infrastructure. And the first thing I did was, let's go and diagnose our human capital strategy. That's the first thing. That's the first exercise. And we set a vision and said, you know what? We want this to be the best platform in Mubadala that attract the best talent, retain the best talent, and actually create leaders for the company. And we spent about 6 months. We've hired external consultants, and we kind of try to understand what are those shortcomings that we need to fill in order for us to set ourselves as a destination for high-quality talent. So leaders have to think about human capital every single day, and this has to constitute a big part of their day-to-day. So we're not investing just in investment instruments. We're investing in people, and people are the ones who are doing actually the work and making the decisions and the conclusions and delivering. So, and back to your specific question, it's important when you resource your team, when you structure your team, is to take these things into consideration: experience, passion, hunger, energy. So you want a bunch of high energy people, but also you want an experienced guy that can kind of, keep them disciplined and keep them kind of, focused. So
That's great.
that would
Sarah?
be my
I'd say for us, two things are stability and long history of investing in asset classes. So Nuveen is owned by TIAA, and so we have a very stable business because about 40% of our assets are from our parent, and then the other 60% is third party, which is a market we've been growing in for a long time. Because of the general account, which is on the TIAA side, we've had a long history of investing in asset classes. So private credit, we've been investing in private credit and alts for decades. Within our 1.3 trillion, over 300 billion is in alternatives, which is a very sizable business that people don't always think of because it's such a large business within a bigger companies. But we are one of the largest alts players probably in the world at this point. So that history, for example, we started our alternatives brand, which is Churchill by Ken Kinsella over a decade ago. Gives us an advantage too because we've been a long-term sizable player in that industry. So I think that he gets to really look at around the whole landscape for the deals that make a lot of sense. In equities, we started investing in the 1950s, international equities in the 1970s. So a lot of people, when they come to work for us, it's a sizable asset class. Over 400 billion of our assets are in equities. They're excited to come and join a firm that has stability. And when markets are volatile, we're not dealing with tons of outflows and things that can make people have to maybe invest and make decisions in ways that they wouldn't want to make at that point. So we've been fortunate, very experienced people. I've been at the firm 22 years, 30 years in the business, always as an investor. And I would say when I look across the board, like our CIO of fixed income, 20 years at the firm, more than 20 years in the industry, it is important to have gone through those cycles. You've gone through the dot-com boom, the GFC, the COVID crisis, all of that you learn from. And then, when you go through these periods like last month, I'm not saying that we're all just calm about it, but, really understanding, though, that what are the nuances here? How are we going to get out of this on the other side and making the right investment decisions rather than panicking?
It's important to really be patient, isn't it? Patience and knowing and having the perspective to know what you don't know at a given time. We got a couple of good questions here from the audience. I want to use them. Let's throw in liabilities and benchmarks, right? Because we should really tie this to some measure of reality. And Jeb, why don't you lead us off? What benchmark and time horizon are you using when you measure alpha?
So it's a great question. And the way we approach constructing the portfolio, we start out with a focus on our liabilities and a focus on the nature of those liabilities, stickiness, interest rate sensitivity, and so on. So we basically have a duration range that we're very comfortable in. Part of that, I won't go into why, but we pay a big dividend, so that gives us a lot of flexibility in terms of duration exposure. But we start with liabilities, we start with our financial strength, and that allows us to construct really a strategic allocation that we expect to be kind of long-term through a cycle, 5 to 10 years. So that's the strategic allocation. We then take that, each asset class gets a benchmark, and we say to our internal teams and our external partners, now beat this benchmark. And so our time horizon for those, we get measured on 5-year total return by our board. We think that's an incredible advantage to be really long-term focused there. The last thing I'll say is we've gone through in the last decade or so a lot of optimizing our benchmark. And I think, there's a lot of arguments in the retail world why people use the AG. That's a pretty general benchmark. It's also pretty easy to generate, carry relative to that benchmark. We've done a lot more customizing on our side in public markets in particular to try to get to a benchmark where we think the bar to beat that benchmark is really high. And that's both a challenge for the teams and an opportunity. And historically, they've really delivered. So that's the way we think about it.
Thank you, Ashley.
On our end, we always start with the liability. I mean, that's the first answer to how should you allocate your assets. Well, tell me what my goal is. Like, what am I trying to manage to? And every one of us is going to have a different situation. In Texas, we have a very young workforce. I represent teacher retirement system, so we have over 2 million teachers and public education employees, all the way from preschool level up through college. When we get $1 from them, we have it for about 26 years before it needs to go back out. So it is an incredibly long duration portfolio, and that's why we lean hard. We don't need that fixed income because we don't need necessarily the income or the coupon from anything. So we look at actuarial rates, right? And I think one thing that's really interesting and a unique challenge is it is a blessing and a wonderful thing that longevity is extending across the globe. That makes our job harder. Whenever we do our actuarial returns, we find out that our beneficiaries, our teachers, they're living longer and longer. That means that pension needs to last longer and longer. So where we sit today is we are at 7% is our actuarial rate of return. That doesn't sound that bad. It's like, oh, okay, that's pretty good. Well, when we look out, we think the forward outlook for public equities is maybe around a 6% return. So that's a lot that we need to make up in non-public equities. And so that is in part why TRS itself is heavily private oriented. I believe in the United States we may have the largest allocation to private assets. Right. It's about 50% of our book. Right. We manage internal and external. We have a large team of quants. And at this point we have 260 investors, and that's just light speed away. Our board's been really generous to us. But we're trying to make 7% overall. That's the short answer. And then each individual team is incented. We actually use a 1 and a 3 year. It's 1/3 based on a 1-year return, 2/3 based on a 3-year. And I agree 5 years would be better. However, we've got so many younger people coming in that if you had a bad 3-year period, it's going to be a little harder to retain them. And so we actually have to think about our incentive systems. In a public plan, we are somewhat constrained around how compensation works. We have to give people experience. We have to give them exposure. We have to give them challenges because we can't rely on just cutting a check. So a little bit of a long answer.
But detailed. Thank you. Dave?
Yeah, I mean, I think I said a little earlier, you've got to have some risk reference point, in a goal that you're trying to achieve. And I think, and again, for us, our business is roughly half our parent company general account and half third party, and then that, a variety of different risk profiles in there. But I think generally you want to certainly earn your fee and then generate something on top of that. And then you also have to me, think about, too, in some of these asset classes, can you buy the benchmark? Like you can, certain asset classes you can buy the benchmark. The sort of lower down the risk spectrum and more illiquid you get into things, you can have a reference point, but you can't necessarily go out and efficiently buy that benchmark. So, it's a nuanced conversation when you get into that with a client of and again, it's back to what's the goal, being clear about that from the outset, and how do you measure success? And then in the multi-asset context, what levers do you have to achieve that success? And then overarching all of that is especially in a multi-asset context, is how are you managing risk at the portfolio level? Because I think everybody likes to talk about deals. Like, we did this one deal, it was great. We did this one deal, it was great. And sometimes when you get into a multi-asset portfolio where you've got multiple teams managing it, and again, maybe this goes without saying, but you've got to have someone overlooking the whole thing and looking at correlated risk that may be building up, because within each team, like aircraft's a good example of, capital intensive industries, and your ABS team may be getting exposure there, your corporate team may be getting exposure there, and then you wake up and at a portfolio level, you didn't realize, because each sleeve built up this risk, and then COVID happens. And you're like, wow, we got a lot of exposure to aircraft. Who was watching that? So having that risk overlay is really important too.
It's all data centers now.
Yes,
Data centers, we have 4 different teams that see data center opportunities and look at them and want to do them. Yeah. And so it's infrastructure, it's real estate, it's our private equity team, and then it's my team as well. And that's just on the private side of the house. We're not even talking about what the public guys want to do around data centers.
Capital-hungry industries are going to go wherever they can.
They're going to find the money, right? We got there's some people in the audience, right? You guys are very good at finding the different pieces. But someone does have to sit on top and just say, hey, do we have too much? And at least part of my job is to look and say, do we have too little? of
Well,
certain things. So.
I want to give each panelist the opportunity to answer the last question, given the time that we have remaining, and you know, because this is a conversation that could keep going on for hours. From your vantage points, what defines a alpha-oriented, as the Institute calls it, an alpha architect today, really, a successful one, that is? And what lessons have you learned about actually managing across all the cycles that we've discussed, real lessons that you can share and impart, and those asset classes? Sarah, do you want to start off?
I think what I've learned over cycles is keep a cool head. Make sure you're doing your homework, because those are the volatility is the opportunity where you can lean into some of these asset classes, and that's where you can make the most money. The biggest returns usually happen in very short periods of time, so trying to time that is very difficult, and trying to wait for that piece of information. I think Ashley said earlier that, you know, her clients who were saying, "Oh, I'll buy that when it goes down a little bit more." I hear people say that so much, and we never get to that level. And then I guess I'll go back to the importance of financial literacy. I think is very important. I didn't have any when I was growing up, so making sure that investors are educated and understand how to meet their retirement goals are important. And then maybe finally, I'll just go back to make sure that you don't listen to bad advice or follow the consensus, because if I did, I would have never gone to college. So remember to ignore the naysayers and you know, do what you think is best. And I think that's a great way to also think about investing is follow your own path.
Thank you. Jeb?
Yeah, I think reflecting on what Khalid said earlier, I mean, I would say one thing for us as an institution is sort of know what you're good at. We're good at long-term relationships. We have a long time horizon. We have great liquidity. We have great capital to manage through these cycles. So design the portfolio accordingly to take advantage of those. I think the other piece of it is just having sort of humility and recognizing that while there's always different flavors of markets, ultimately valuations can be a pretty good guide for where you are. So it's a terrible short-term timing tool, but thinking about, you know, everything's a combination of equity risk, credit risk, spread risk, liquidity risk. I'm sorry, rate risk and liquidity risk. So like these are all flavors of the same thing, and looking at those valuations and trying to be disciplined, that's another thing that we think is important.
Dave?
Yeah, for me, it's just never forget the fundamentals. Like, no, you know, I mean, there's times where things are in vogue, out of vogue. Don't get too high with a high. Don't get too low with a low. Focus on fundamentals. Protect downside. I always talk with our team, the 80-20 rule. 80% of what you do is going to work out just fine. You're going to spend 20% of your time on it. 20% of the things you do, you're going to be like, yeah, that didn't work the way we thought it would. And it's how you manage that 20% that really, really matters. And you have to think long term when you get into those situations. And we can all point to situations, you know, if any manager that has, you know, no defaults probably has bad returns, because that just means they're just selling as soon as something goes wrong. And you can have a situation that goes bad and you can recover more than your principal investment. You recover just barely all of it, or you can lose all your money. And so really, again, that how you manage that 20% of the stuff that doesn't work quite the way your base case was when you invested is, to me, what makes a difference over a long period of time.
Thank you. Ashley?
Oh, I'll just echo the other panelists and say you've just got to be ready in advance. In particular, I think, given the way how fast markets move today, we just don't have a lot of opportunity. So, you know, even in COVID, that was 3 weeks. You know, really paying attention to liquidity, having the right kind of relationships in place. You know, we have a very large internal team. We also have external partners that we rely on. We need both of them to go out in times like these and find assets, because it can be hard to locate. And so not having that fear, but being ready in advance. During 08-09, we put a lot of money out, but we probably lost 3 months worth just in the legal structuring alone. So my other thing would be, let's fire all the lawyers and let's just like, can we just give you some money, you go invest it? That would be great.
There's Texas. Yeah. And then Colin.
You know, I think my my colleagues here, you know, alluded to most of these lessons learned, but I want to leave you with one, which is information advantage. You need to have information and know things that others don't know. This is really kind of one of the most important pillars to be able to differentiate yourself and create alpha. And what they say local eyes beat global noise. And I want to give you an example to basically elaborate what that means. We have an investment team that's based out of Brazil that manages third-party capital. That's part of Mubadala. And they've been in Brazil for so long. And we have about 40 investment professionals. And they have delivered in their first private equity fund 28% USD IRR. In their second private equity fund, 38% USD IRR. And the reason? Because they're there. They've been there for so long. They're Brazilians. They're having breakfast, lunches, dinners with Brazilian people. They're close to the market, and they've got the information advantage. And that actually helps, especially in a market where there isn't a lot of transparency and there isn't a lot of public information available. Thank you.
I feel like I'm in a club and it's 2 a.m. in Miami. Later on, I'm like, have I been here that long?
Well, we could go on longer, for sure, and I encourage you to find the panelists afterwards and try to. Thank you. Please join me in thanking an esteemed and really informative panel. Thank you very much.